Hello everyone, on this video we will continue taking a look at some of the fundamental economic indicators used by Forex traders. Okay, so the big main topic is central bank monetary policy. First, interest rate decisions. The amount of interest charged by a central bank is extremely important to the valuation of a nation's currency. If a currency's central bank sets a high interest rate, barring other factors such as political instability, for example, that nation's currency tends to attract foreign assets from countries with a lower interest rate. Central bank rate statements. Most central banks issue a statement after a rate release describing their monetary policy committee's voting and the reasons the rate was changed or left unchanged. The statement could affect the market if the policymakers' voting was unexpected or if the central bank has a more hawkish or dovish demeanor for future rate decisions. Policymaker and central bank official speeches. The content of a speech by the president, governor, or other officials of a major central bank can sometimes give indications of the bank's future monetary policy, which will also affect that country's currency. Other key policymakers include the voting members of the central bank's monetary policy committee, and while their speeches may not carry the weight of a central bank governor, they could also have an effect on the country's currency depending on the content of the speech. Asset purchases and quantitative easing. The amount of money a central bank uses to purchase debt securities and other assets to support a weak economy. Increases or decreases in the amount of stimulus measures can have a significant effect on a nation's currency because changes in asset purchases can indicate a change in the interest rate and money supply. Geopolitical events. Wars. The breakout of a war or a ceasefire significantly affects the valuation of a currencies issued by the nations at the war, and sometimes, depending on what countries are involved, the forex market in general. Wars can also significantly affect commodity prices and other assets produced in the nations involved, thereby affecting the currencies of other countries that produce similar assets. Elections. A change of regime or political majority can significantly affect the value of a nation's currency. If the incoming government favors capital incentives and lower interest rates, the value of the currency could be negatively affected. Other types of popular votes can also significantly affect the valuation of a currency. For example, a referendum on a country's exit from the Eurozone might substantially impact the value of the euro. Power changes. A nation that has had a change of power such as coup d'etat or a forcible regime change could experience a complete revaluation or devaluation of their currency. Natural disasters. When a country is hit with a substantial natural disaster, that nation's currency typically appreciates in the short term due to the need to repatriate money of disaster relief. Nevertheless, in the long term, the currency could be adversely affected if the natural disaster has a considerable negative impact on that country's economy. Okay guys, this is all for today. I hope that you enjoy this video and see you next time. Bye bye.